Welcome to the Depth Dive. Our mission today is to analyze the high-stakes intelligence briefing that landed this morning, January 1st, 2026. And this isn't just another market update. The data we're looking at here, it signals a really structural break from the past. It means the rules you thought you knew about this space are, well, they're probably obsolete.
That's the absolute truth. I mean, if we really boil down the core message from this report, it's that the era of just relying on simple calendar cycles, that easy programmatic momentum, it's over.
So what's replaced it?
The market has entered a state the briefing calls constructive disillusionment. We're now moving into what they term a hardening phase.
A hardening phase. What does that mean in practice?
It means the primary measure of value for any asset will be its true, verifiable resistance to centralized power, to surveillance, and to, sophisticated cyber threats.
That sets the tone perfectly. So if this is the hardening phase, we have to start with the big data point, the one that caused all the disillusionment in the first place. I'm talking about the formal invalidation of that decade-old four-year cycle thesis.
Exactly. It's a technical reality that's forcing a complete psychological shift. I mean, if you look back, the year right after a Bitcoin halving, 2013, 2017, 2021, it always produced this massive parabolic expansion.
It was almost a guarantee, right?
It's essentially guaranteed appreciation, built right into the code.
But the data for 2025, it just completely defied that.
It did. The briefing notes the anomaly so clearly. Bitcoin opened 2025 near, $93,462?
Right.
And yet it closed the year trading down in the $87,500 range.
So if you do the quick math on that.
It's a decline of approximately 6.3%.
Yeah.
For the post-halving year. This is the first time in Bitcoin's entire history we've seen a negative performance in that crucial cycle year.
A negative performance is a seismic event. What does this do to the big historical theories like the stock-to-flow model?
It functionally invalidates it. I mean, the S2F model was all based on scarcity driving predictable exponential growth after the halving.
And if the price goes down after a supply shock,
then the model's core assumption that scarcity is the only driver is just shattered. But more importantly, this confirms a deeper structural change the report calls beta drift.
Okay, let's pause there. Beta drift sounds like exactly the kind of jargon that makes people tune out. What does that actually mean for you, the everyday holder?
Simply put, the U.S. spot ETFs have successfully financialized Bitcoin. It's not this idiosyncratic asset anymore that just marches to its own drum.
It's a high beta liquidity sponge.
That's the term, yeah. It means its price is now much more correlated with global macro variables, things like the M2 money supply, global interest rates.
So M2, the amount of cash flowing through the global system, you're saying Bitcoin now acts more like a big tech stock than its own thing?
Precisely. When liquidity gets pulled out of the system because of, say, high interest rates, Bitcoin feels that pinch just as much as the NASDAQ does now. The ETF market has, it's capped the volatility and dampened that speculative mania from prior cycles.
And we saw that fragility play out in the last 48 hours of 2025, didn't we? The ETF data was brutal.
It was. We had that brief, hopeful spike, about $355 million in inflows.
Right. Suggesting some institutional commitment, but then...
Then the immediate signal was a $348.1 million net outflow on December 31st.
So a complete wash.
The definition of a wash. It tells you the institutional money wasn't committed long-term. They were using the ETF like a short-term trading vehicle, not a savings account. The capital commitment is just. It's fragile.
So where does this leave us technically in the first hours of 2026?
Well, Bitcoin closed 2025 in a state of true indecision, a doji candle for the chart watchers out there.
Meaning the open and closed prices were almost identical.
Exactly. Buying and selling pressure just canceled each other out. Total market confusion. The immediate level you have to watch now is the $87,000 mark.
The briefing calls the line in the sand. Why is this line different from all the others that failed last year?
Because $87,000 is a huge psychological and technical support zone. It's tied to that consolidation range from the mid-year peak. A sustained close below it would technically invalidate the last 6 months of bullish structure.
And if that line breaks?
The door opens for a very quick flush down to $84,000, maybe even $80,000. It's not a strong start to the new year.
Okay, so let's shift gears a bit. Moving from the market structure to the regulatory environment, which has had its own big bang of compliance.
This is maybe the most defining geopolitical development we're seeing. We're talking about the OECD's Crypto Asset Reporting Framework, CARF.
And as of this morning, January 1st, CARF is now operative.
Yes, across the UK and over 40 other jurisdictions.
And this framework is being described as Well, the most comprehensive financial surveillance apparatus ever deployed in crypto. Why is it so much more impactful than previous regulations?
Because CARF invades the self-hosted sphere. Think of it like this. Before, the government could only really see what was happening inside the exchanges.
Okay.
CRF changes that. It mandates that crypto asset service providers, your Coinbases, your Krakens, they have to report much more granular data.
Like what, specifically?
Your full legal name, residential address, your tax ID number, and critically, they have to identify the beneficial ownership for any corporate entities.
Okay, but here's the key. How does it reach outside the exchange?
This is the mechanism that changes everything for you. If you withdraw Bitcoin from a compliant venue, say Coinbase UK, to your own external ledger hardware wallet,
Yeah.
that withdrawal is now a reportable event.
Wait, so the very act of securing my own funds, taking them off an exchange, is now flagged and reported to a government agency?
Absolutely. The exchange has to log that destination address and link it directly back to your tax profile. And the strategic impact is enormous because this data isn't kept local.
Right. It's going to be shared.
Starting in 2027, covering all of this year's transactions, this info will be automatically shared, AEOI. So HMRC will be sharing data directly with the IRS, the German authorities, the French. It's a global dragnet.
So this is forcing a massive bifurcation.
Right.
Your capital is now either fully compliant and totally transparent, or you are explicitly moving it into the dark. That middle ground is just, it's gone.
That is the new structural reality, and it's happening in parallel with U.S. regulations. As of today, the IRS is now requiring U.S. brokers to start tracking and reporting cost basis.
That's the new Form 1099 DA for digital assets.
Right. It standardizes crypto reporting to match stocks, basically. It ends the ability for compliant investors to use ambiguous accounting to, potentially hide gains.
Every compliant exchange is now a tax surveillance node.
For the U.S. Treasury, yes, compliance is no longer optional in the developed world.
Okay, and this is where it gets really interesting. Moving from regulation to the existential threats. The briefing notes that the threat has shifted upstream. It's not the blockchain itself, it's the application layer.
Yes. This is confirmed by two massive campaigns uncovered recently, both targeting the browser environment, which is unfortunately how most of us interact with Web3.
Let's start with the Trust Wallet incident. They're calling it the Shai-Hulud attack, an $8.5 million theft, but it wasn't a smart contract flaw.
That's the key. It was a supply chain injection. The attackers didn't compromise the blockchain, they compromised the developers.
Oh.
They stole a TrustWallet developer's GitHub secrets, their core credentials. And with those, they got access to the Chrome Web Store API key.
Which means they could just upload a malicious version of the extension, v2.68, directly to the official Chrome store. It bypassed all the security reviews.
Exactly. And that malicious extension had a script that just harvested mnemonic seeds when users unlocked their wallets.
So even if you followed all the rules, didn't click a shady link, kept your software updated, the official store itself was serving up the malware.
Yes.
This fundamentally breaks the don't trust, verify model for these auto-updating software wallets, doesn't it? What protection do you actually have left?
In the browser extension ecosystem,
Well.
very little. The analysis suggests this is going to force a major and probably necessary migration towards hardware wallets and maybe desktop apps where the updates are more controlled.
Yeah.
The vulnerability is just too high.
And the second major attack, DarkSpectre, hit over 8.8 million users.
Yeah, and this one seems focused less on direct crypto theft and more on corporate espionage.
So what were they after?
The primary goal seems to be targeting meeting links from Zoom and Teams, stealing corporate credentials. The infrastructure has been linked to Chinese threat actors.
That is a nightmare scenario for any company. An employee downloads a simple PDF viewer extension, and suddenly their firm's entire operational security is compromised.
It is. And it reinforces a strategic imperative we're seeing elsewhere in DeFi, this move toward governance minimization. We saw the Unleashed protocol lose $3.9 million because of compromised multi-sig keys.
Right.
If the security threat is this high, protocols simply have to burn their admin keys because anything governed by multi-sig is just a central point of failure.
Okay, let's transition now to the philosophical and political landscape, which is really driving the next phase of all this. We're seeing two vastly different visions for the future emerge.
We really are. On one side, you have Vitalik Buterin laying out his vision in a new treatise called Balance of Power. He argues the 21st century has enabled this dangerous centralization, what he calls big business, big government, and big mob.
And his antidote is what he calls mandatory diffusion and adversarial interoperability.
He's basically calling for developers to build decentralized tools that force open these closed centralized systems. It's setting the ideological tone for Ethereum's evolution, a renewed focus on privacy and censorship resistance. It's a call to arms for resilience.
Now, you compare that cypherpunk ideal with the immediate reality of PoliFi normalization, a completely different playbook being written by the Trump Media and Technology Group, TMTG.
Indeed. TMTG just announced a partnership with Crypto.com to distribute a new reward token to its shareholders. It shows how mainstream PoliFi has become.
So what are the details on this token? Why is the structure so important?
Shareholders get one digital token per whole share of DJT they own, issued on the Kronos blockchain. But here's the key. They are explicitly positioned as non-transferable utility tokens.
Non-transferable.
Yeah, they're meant to unlock benefits on platforms like Truth Social. That non-transferable aspect, that's the legal sidestep.
It seems specifically designed to prevent speculative dumping and avoid scrutiny from the SEC, which might otherwise call them securities.
It's a deliberate effort to skirt the spirit of the law while embracing the tech. And look at the mutual investment here. TMTG is buying $105 million in CRO tokens, while Crypto.com is buying $50 million in DJT stock.
A very powerful, formal financial alignment.
It is.
So while this ideological battle rages, what's happening in the rest of the altcoin market?
Well, starting with Ethereum, it's struggling to find a cohesive institutional narrative. The U.S. spot Ethereum ETFs saw $72 million in net outflows on December 31st.
Why do you think that is?
Institutional capital seems uncertain. It's caught between Bitcoin's digital gold story and the super high-speed chains that are built purely for speculation. Ethereum's sort of stuck in the middle.
Then there's Ripple. The scheduled release of 1 billion XRP just happened.
Yeah, that's a massive headline number, and the market is hypersensitive to supply shocks right now. However, historical data shows Ripple usually relocks 60 to 80% of those tokens pretty quickly.
To maintain supply controls.
Exactly. So traders should watch the chain for those re-escrow transactions. The net supply increase will likely be smaller than the headline suggests.
And finally, we have to talk about the legal precedent being set against a major DeFi protocol. This would have huge implications for everyone building in this space.
Absolutely. The Rosen law firm class action investigation against Balancer. That's critical. The charge is misleading investors about their security after a hack, and this effectively pierces the DAO veil.
The DAO veil being that legal shield developers and token holders thought protected them from liability. Why is this specific lawsuit such a foundational threat?
Because it treats the governance token, BAL, as a security. And it treats the DAO itself as a functionally centralized entity that misrepresented its product's safety. If Balancer can be sued for a security failure,
then it suggests that governance token holders or the core teams behind protocols can now be held legally liable under securities laws for any failure.
it creates a liability precedent. It forces founders and investors to seriously consider the legal exposure of just holding admin keys. The message is clear. If you can govern it, you can be sued for it.
So let's synthesize this. The strategic outlook for 2026. The intelligence briefing makes it clear. The party is over. We're now in the audit phase.
Correct. The market is demanding maturity. Value is going to accrue to assets that provide verifiable resistance to surveillance, to censorship, and to cyber warfare.
We've seen 4 major shifts confirmed today. First, the market has to abandon the 4-year cycle model. Bitcoin is a global liquidity proxy now.
Right.
Second, global compliance is mandatory through CRF, which destroys that semi-private gray market. Third, the security focus is now squarely on the user interface, specifically browser extensions. And fourth, ideology is driving asset design, split between that cypherpunk vision and the rise of PoliFi tokens.
The battle for the future of capital is now won over centralization, jurisdiction, and security.
Which brings us right back to that Balancer class action investigation. If the DAO veil is truly being pierced, if legal liability is now extending to decentralized protocols, what does this mean for the future of decentralized governance? Do projects need to become completely locked down, burning all their keys the moment they launch just to avoid being sued? That's the high-stakes question you must mull over as you navigate this hardening new year.